and Adem, which I know is Adem. Welcome back to F.A.C.E. How are you? Adem?
Hey, sorry, Dale.
I hear
Doing
you
pretty good.
now, bro.
Okay, yeah, sometimes I mute my mic, but how are you doing, sir?
Good, good. It's amazing, after we do an interview and we book it out several months, it's amazing how time flies, and here we are again together. So, okay, gosh, nice looking page. You got your
Oh,
website
thanks, man.
going.
Yeah, I was actually
Congratulations.
looking at it was interesting when you were talking about Target before I joined this. This is something I wanted to actually bring up while you were talking at so in the boom phase, for many aren't familiar, there's a really good report by, it's called the Sherman Simulations. I forget the exact name. I'll find it later and I can put it in the chat. But basically, he was an economist and he went and he looked at the micro cap business cycle and how it oscillates, like meaning how entrepreneurs like Target, like you said, Walmart, they have to load up on inventory. And in the boom phase, there's like three factors. You have like a time lag, then you have production, like new production coming online, then you have forecasts of the economy. And all three of these are in their own systems and they're always either amplifying the cycle higher or they're working against it lower. And we always see it. And so in his conclusion, he looked at empirical data and he showed that forecasters, businesses are terrible when it comes to forecasting proper inventory, meaning when prices rise, they load up on inventory, boosting prices higher because of the added marginal buying. Also, new supply comes online, but then it gets to a point like 2020, Fed starts hiking rates. So all these retailers now are stuck with a glut of goods with weakening demand globally. And now they're starting to have to dump some of these discounts are going for 30 to 50% off wholesale of goods that they purchase just to, get these things off their book and raise
And
cash.
sometimes not the size of the inventory, but the type of
Yes,
inventories that they've been getting
exactly.
wrong.
Hey Adam, good morning. Good
Hey,
to
Blake,
hear
how you
your
doing?
voice. By the way,
You too, sir.
it's funny you mentioned this. I just gonna tell you guys, it just fits right into this. I was over at my neighbor's house, and I had to go grab something from their house. Anyway, his wife comes back, and they happen to be looking for new patio furniture, and she was out at Home Depot, and she's like, oh my god, and she's like, hey, can you guys help me grab these boxes? And we go out to her, her SUV, and she's got like brand new like chairs and all this stuff. She's like, I couldn't pass up these deals. These are like 50% off these, all this stuff. And she's like, I had to buy it all. Like, but it's crazy because big retailers are just dumping stuff.
Yes, they are.
Yeah, it's nuts. Anyway, all right. Hey, good to hear your voice and good to see you. So I'll let you continue on.
Great. Oh, yeah. Thank you, Blake. And that's true. I mean, there's a lot of
Yeah, Target got that whole thing rolling about a quarter ago.
right.
Where they got it wrong. They were buying a lot of, stay-at-home stuff, technical stuff, computers, TVs, where people were getting out. They wanted the experiential stuff. They needed clothes, not a
Right.
flat screen. Can't wear a flat screen to a disco.
No,
And
it's
yeah. So, okay, so I'm going to shut up here. Tell me what you're
Oh,
thinking.
no worries. No, I was, and you're right. And with these firms, so I see a lot of individuals there, rightfully so. They're, how's the inflation getting so bad? And there's actually another cause that is super underfollowed, underrated, but there's this great book I read recently. It's the Great Reversal. I forgot the author. His name was something Philippon. Great book, but he went and showed how since the 1980s, basically the U.S. and major European companies have become oligarchs. And this chart I'm showing right now here is to give it perspective. Since the 1990s, we saw publicly traded companies peak around like 8,000. It's below 4,000 now. That's a 50% drop in public companies. And yes, there are private companies, but we're seeing a lot of private companies merge together, and then they do these big massive deals where they go public. Google Ads runs like 80% of the ads market. Tyson Foods runs like 90% of the poultry business. The top 5 airliners, and this is before Spirit Air and Frontier, which was like a low cost thing, merge. They controlled 80 to 90% of the total air traffic in the US. The top 5 banks control over 70% of the assets. The top 2 beer companies control 90% of the market. And the most egregious one, in my opinion, is that 75% of US homes have only one modem provider, meaning like Cox Wireless or whatever you can get. And it's this restriction of supply of
and
new
no,
companies.
And no competition.
No
So
competition.
competition brings down prices, and they've eliminated 50% of the competition.
Absolutely. And that's the important factor, is because the data showed that when there's not competition, meaning there's more oligarchs, like a centralized, it's called like
We're
business
turning
consolidation.
into Russia.
Yeah, it's more or less. And they restrict. So if these companies restrict supplies deliberately, which keeps prices higher, it keeps wages lower, keeps productivity lower, creates investment lower. All 4 factors are, and there's actually another great chart. It shows some hedge fund that bet against, and not to mention these major firms who do lobbying, and it shows them, let me find it, lobbying.
Thomas Philippon.
Yep.
See, we have an educated audience. Thank you, BR.
Yeah, it's a great, this is it. This is such an insightful thing. So the firms that invested right here, the firms that invested, they invest the strategic lobbying portfolio. They invested in the firms that invest more in government, meaning they actually, so the government gives their lobbying money to these governments so that they can prevent supply. There was recent data that showed cities with the most oppressive building laws have the highest prices. So their governments restrict building in like San Francisco and Portland without letting new supply come online. And if you look at it, the strategic lobbying portfolio total return, all they did was invest in the top 50 companies index that derive significant earnings benefits from lobbying activity. So for those not familiar, it means lobby power per dollar.
Yeah.
And it outperformed the S&P 500 in a 10-year period by over 160 points. Just investing in nothing great, just those firms that invested more heavily in government, basically handouts and regulations. Because
you think Elon Musk Tesla might fit into that profile?
I'm sure they do. I mean, their tax credit was like a big savior to them, and also he was selling his tax credits to other companies, and it's just really it's really a insidious crony cycle that these things devolve into, because these companies, one of the big theses in Philippon's book was that regulations only kill small businesses. They only hurt small businesses. Big businesses want regulations because it protects them, it insulates them. You know, they can survive.
They can pay the lawyers.
They can pay the lawyers. And here's the real kicker. When you get a big company like Philips and et cetera, growth declines. I mean, we all see it. Like, you know, when you get to big scale, bureaucracy takes over and then scale kicks in and you can't grow like you used to. The lifeblood of America historically has been small businesses, because that's where you get that really big growth. Because one business who doubles his workforce from 10 to 20, you know, it's 100% increase. And then you have like, you know, a big firm hiring 1%. Yes, their scale is larger, but that doesn't create growth momentum. I like this one great analogy. It showed a village. There was a scientific study. It showed a village in Vietnam. And they, you know, back then when they would collect the rice paddies, they'd have their big upside down, hats, and they'd put their rice extra and walk it back and forth. They gave them one truck, just a 4-wheel drive truck. It increased their productivity some 300%, just one truck. But imagine giving another USPS today, the, you know, big FedEx or whatever. Imagine giving them one more truck. You won't see their productivity increase even in the slightest way, because they've already expended so much energy. They're already in such a scale that everything has marginal. You get to a point of law of diminishing returns, and that's what we've seen with big firms. They get to a point where same with the government. The bigger the monopoly, the more you invest, the less marginal returns there are. It's actually becoming negative at this point. The government pumps so much money in and all these things, and they're barely squeaking out growth.
Okay, so, you know, there used to be a lot of brokerage firms as well in the U.S., and that's been the Baton Death March, and they knock the little broker dealers, make it so expensive they don't want to stay in business. And what do you think the effect's going to be of the new legislation and all these new IRS agents probably going after the small businessman. I hear that's one of their targets, the sole proprietor. That is only going to exacerbate. We need them to thrive.
I agree.
And
And in my opinion, no, you're right. What is it? The Inflation Reduction Act, the most improperly named bill
it's an
ever.
oxymoron.
It is an oxymoron, because, and in my opinion, they're adopting see, this is an MMT fallacy, which they've shown
Named by a moron on Oxy.
Yeah, more or less. And all the cronies too, getting paid by Purdue, and they get basically they get they're adopting the MMT style from I forgot the lady who wrote it's a really atrocious book for anyone who wants to really read The Deficit Myth. Reading it will give anyone who understands like basic economics, it'll give you a pounding headache, but it's worth reading what the hype is about. But this was before 2020 came out, and the thesis is, if inflation's running hot, the government, not the Fed, just needs to suck money out of the economy via taxes, which it doesn't really make sense, because the government, it's not like they're canceling those dollars with taxes. They're just redistributing it. So if I was going to go out and buy a new car with that money that I got taxed with, the government's going to spend it where they want. So it's like a zero-sum game. It's not, it's not like you're just taking that money out of the economy. So the Inflation Reduction Act, they're like, we're actually going to increase the deficit in the next few years, but in 10 years that are balanced. Well, Jesus, if we listen to politicians, every 10 years, the budget would be balanced. They do this. They're like, it's going to be balanced in XO years. And then a little bust happens. And then they end up like a COVID or 2008, 2015, et cetera. And then they have to end up printing trillions more, running trillion massive deficits just to get the same eked out 2 to 3% GDP growth that they can barely get.
So as far as optionality goes, Adem, and I know that's your forte. Last time we talked, you were a contrarian. I don't know if it's still working. You were getting long, I believe, F.A.C.E or something in China.
That hasn't really. China's been a basket case. Let me even see what the X is. This is lower than I even bought. Those options are probably going to expire worthless, because I was reading how China's data has been so bad with COVID, and I'm seeing that they're trying to take out certain stocks out of the major indexes. So
who knows? Forget the post-mortem on that.
Right? At least long bonds was something that's worked out, because that was another thing I was going to say, is the inverted yield curve. It's more inverted now. It's basically about to hit like a 40-year low. I think right now 1998 has the highest at like 0.45 negative. Right now we're at 0.43, and it's rising every day as the Fed continues hiking. This thing's going to keep going deeper. And for individuals not aware, the inversion of the yield curve curtails bank lending, because banks use the yield curve as a proxy, because you borrow short, lend long. But if the Fed is arbitrarily hiking up the short end of the curve, and then you have investors seeing it plant the seeds in the next recession, because since the 1980s, we've been such a credit-fueled economy, or global economy in that aspect. Like I was hearing you earlier with the stocks going up, the data is looking pretty grim, and it's just going to go lower, in my opinion, because of lag effects. But individuals are pricing it in stocks, because from now on, it doesn't matter. Growth doesn't drive equity prices or asset prices anymore. It's not like the old days where if it grew, your assets increase. Now it's just the flows of liquidity. So if the central banks are easing, boom, pumps up asset prices. Doesn't matter if your economy is doing good or not. I mean, they're correlated, but either way. And then if they start hiking, even if you have positive growth, you're going to see asset prices plunge, which we saw with Bitcoin. Cryptos, NFTs, all down like 50, 75% since 2022 started, just from the Fed tightening.
Okay. So you like the bond market? Does this make you kind of a deflationist? The opposite? Except a lot of people are buying peak inflation. Is it?
No, I think we hit peak. I wouldn't say smart. Maybe I got lucky, but in June I said that was going to be peak inflation growth, just because since June, because as we've talked about in the past, employment and inflation data is all lagging. And then when June's data came in, we're already halfway through July at this point, and we've already seen oil. Oil was around like almost $7 a gallon. Now it's almost at $4. right? And then we saw the, Biden was touting it like, oh, there's been zero inflation, even though that's disingenuous because it was just 0% monthly. But in year-over-year terms, it was like almost 9% still. It was 8.5. But I think we hit the peak in inflation in June, and we're going to see it just trend lower. But the insidious part is that even if inflation is zero, let's say monthly change zero for the remainder of the year, inflation in year-over-year terms is still going to come above probably 6%. And looking at the Fed, they're probably going to keep hiking. They're going to hike us into a recession. They're going to rip their nose off to spite their face, in my opinion.
Okay, another policy error. So how do you take advantage of? How do you make money with what you're seeing across the the landscape in the markets?
So when the yield curve was at it was at like 0.2. I was like saying like, hey, I'm going long bonds via optionality. Just lock it in because it's a bet. It's basically we're calling the Fed's bluff because the assumption is you're buying. So why the yield curve inverts, for anyone who's not familiar, is that so the Fed hikes up the short-term rate arbitrarily. Like, there's like the market actually does thing when there's like news. It's like the weighing, like Ben Graham used to say, it's a voting. It's not a voting machine in the long run. It's a weighing machine. In the short term, it's a voting machine. In the long term, it's a weighing machine. So when the Fed just comes in and like, hey, we're hiking rates 0.75%, they just arbitrarily pick that number out. There's, you know what I mean? What makes the difference between 0.5, 0.751? I mean, they maybe have some math they explain, but they're arbitrarily hiking it. And you have the long end of the curve, which is betting against them, saying, well, you guys are pricing in higher inflation, higher growth meaning we need higher rates for the future, but we actually think you're planting the seeds for the recession. So we're buying the 10 and the 30 and the 20-year bonds, et cetera, which pushes prices lower because we are assuming that there's going to be deflation and a recession in the future, which you're causing because of your hikes, which is going to slow down the credit and slow down the economy, et cetera. And you're going to be forced to cut again, which is going to make those long-term bond locks in. Like if you're locking in a 10-year bond, locking in at 3%, and then 2 years later, the Fed cuts 10 years, they cut the Fed funds rate, whatever, and do QE, and it brings the 10-year down to 1.5. I mean, you're happy you have that 3% locked in for 10 years. So that's how inversion happens. It's the long end of the investors calling the Fed's bluff, more or less. And we've seen yield inversion precede the last 8 straight recessions. And it makes sense logically and empirically. And I think we're going to see it again, especially with how deeply it's inverted.
Do you think we're in it, or do we have to wait for the lag time of Fed policy to filter through?
I think we're in it at this point, but it's just because they keep hiking. So there's like usually a 6-month gap between these things. So even if the Fed started cutting rates today, there really probably wouldn't be an economic benefit probably until I'd say like January at the earliest, right? And like we saw that with them tightening, it slowed the economy and growth down, and everyone started talking about recession basically in summer once they started hiking in December. And they're aggressively hiking for this. I mean, for how much credit and marginal debt is in the system compared to other cycles. Leverage, yeah. They're really high. If the Fed was ahead of the curve,
the housing market is feeling it, isn't it?
Yes, the housing market's definitely feeling it, and the housing market is like the home builder index recently fell below 50, meaning it's in contraction, and it makes sense because obviously higher rates going from let's say the 30-year mortgage rates were below 3% for a whole year, pumped up. I think historians are going to look back in time at the Fed's policies after COVID for home owners and they're going to just be scratching their head like, why the hell were they doing this? Like they inflated a massive housing bubble within just a year's time. Like why were they buying $2+ trillion in mortgage-backed bonds?
Yeah.
So I think that's going to be
what are you using as a proxy for bonds? TLT?
Yeah, I like to use the TLT.
Okay. Just one
longer end of the curve. It kind of allows you to take advantage of, because I believe in structural deflation, like we said. We see China running China's back to running. Pull it up actually.
How about the dollar here, Deb? Do you think that we peaked at 109 and we're in a topping phase here?
It's hard to say. I don't think so. I think it'll go higher for the midterm, and I think if there's some kind of black swan, we're going to see the dollar go higher, which is interesting because for how much inflation there is compared to the 1970s where we had a weakening dollar, like every country in the world was dumping dollars, we're having the opposite today. We're having investors load up on dollars. So I do think we're going to see the dollar I do think we're going to see the dollar go higher, but I think it will eventually hit a point, maybe like 115. I wouldn't be surprised. But if it did turn and the Fed starts cutting, I wouldn't be surprised. But I don't think it would drop back down deep into the low 90s.
Okay. And the yen is pretty tightly correlated with rates. So if you're looking for rates to come down long term, there must be a nice short in the US dollar yen.
Yeah, that is true. I need to look more into that. Yeah, I need to.
You know what my commission is on that one?
What is it?
I'll talk to you later. I'll send you.
Well, thanks for the insight, and we'll have to discuss it.
Okay.
Yeah, so the China current account, like their surplus versus deficits, they're back to running surpluses we haven't seen since before 2008.
Who is?
China. Yeah, I mean, because when their investment, so basically, Michael Pettis wrote this brilliant book called The Volatility Machine, The Great Rebalancing, another book, and his most recent book was Trade Wars or Class Wars. And in it, he's in my opinion, one of the most intelligent. He lives in China and teaches there, and he's one of the most impressive economists that actually understands real world markets and economics. He was showing that when China has such large surpluses, it's because they have an underconsumption problem domestically, meaning they're producing so much stuff that their people aren't consuming because they're not wealthy enough that they have to export the glut. Germany does the same thing. Germany in 2020 or 2019 ran the world's largest current account surplus, and they're producing more that they're not consuming, and they're dumping it on the rest of the world. Well, that in fact is deflationary because you're forcing the rest of the world to absorb your glut. That's why when the Chinese yuan in 2016 weakened, when they cut the yuan, you saw there was a big deflationary crash in markets because that's making their exports even cheaper for the rest of the world to absorb.
Well, that's starting to happen now, isn't it, with the yuan?
Yeah, we are starting to see that now. Yes. And that's why it's no surprise that we're seeing, like on this chart shows, like 2008, we saw basically their current account surplus peak, 2009-ish, and now it's back to those same levels. For the last 10 years, they were trying to reduce their deficits. That was the whole point. Like they were their current account surpluses. I'm sorry, they were trying to reduce it. Trying to not, they were consuming more as they grew wealthier, so they didn't have to export as much and et cetera. But now they're back saying, hey, we can't get the high quality growth. We're having a housing bubble implode. We need to still hit our growth targets. How do you do it? Exports. That's why Russia, a weird thing is Russia is a surplus running nation since 2015. They have a current account surplus. So when they did these sanctions on them, they were targeting their imports. But when you're a surplus nation, you should be targeting their exports. But since they're such a commodity exporting country, it just shows how hard it is to do sanctions on a current surplus country. And America, so when you're a big country like China and you're dumping a glut of goods on the rest of the world, China and the European Union via Germany, you need people to absorb that debt. So when someone's running a current account surplus, that essentially means someone else, various people maybe, or one big group has to be running a deficit. Someone has to be buying that glut. And America has been buying, essentially importing all these cheaper goods, absorbing the glut from China. And it's, even if America tried doing like a Trump did, like homegrown in America, whatever, we're going to stop importing from China. That's not going to fix the problem of underconsumption in China, which is the biggest marginal growth engine in the world. I mean, since 2008, between 2009 and 2018, China alone accounted for 50% of the world GDP. It's that saying, if China sneezes, the world catches a cold. Yeah, and their entire economy is slowing down. They're basically sliding into a debt deflation cycle, in my opinion, because the average Chinese, they don't have like a savings or pension or social security like in America. So when their largest asset is a second home, that's literally where their wealth comes from. It was like some 80% of Chinese, their wealth or their savings, whatever, for future retirement. And mind you, there's over 700 million Chinese that are supposed to be retiring in the next 5 to 6 years. That's more than double the US population, that they're put all their money in a second home. But now we're seeing home prices decline. And, we saw how that worked out for the US and Europe and globally in 2008. When home prices even start dipping slightly, it amplifies downwards. You have the marginal sellers get out, people who can't pay the loans, pushes prices lower, but gets more selling because individuals don't want to get let out. Your liquidity piles up, you see prices really sink. And God knows, I mean, it's so bad in the US they're trying to cancel, student debt. They're trying to do whatever they can. They're having student loan pauses and everything. They're going to probably just keep doing it, which is an insult to anyone like me who didn't go to college. And I feel individuals who did, and it sucks. But at the same time, the U.S. government is essentially subsidizing. So to put it plainly, individuals like me who didn't go to college, on average, just going off of history, will earn less than a college student. But yet, by bailing out the college student, you're subsidizing a college student in debt who will make more on average than a non-college employee, non-college graduate. So you have the poor subsidizing the rich at this point. And that's not a sustainable system. Also, it doesn't fix the problem going forward. Let's say you canceled all the debt. Well, it's not like people are going to stop going to college, and those tuition prices are probably only going to double knowing they get a bailout next time.
Yeah, I had to pay mine.
Right?
Anyway, so Adem, so much information. People are going to have to replay this interview. Best idea going forward until we talk next.
Well, I'm waiting for this bear market rally I think it's a bear market rally, and I'm looking at puts on car makers, home builders. I think they're dogs with fleas at this point, but like we just talked about, growth and economic data doesn't really drive it anymore. It's credit flows. And I think the Fed is committed to still tightening, and it's only going to make this pain and these lagging indicators, by the time we see inflation get down to 2%, we're probably already deep in a depression, I'd imagine.
How far out do you go out to put on your option strategies?
I try to aim for at least minimum 8 months, 8 to 15 months usually, if I can lock it in real cheap, just off of using heuristics. I like to use the Mark Spitznagel and Nassim Taleb heuristic model compared to like Black Skulls or the binary option pricing model.
Okay, let me know when you pull the trigger, and why don't you show your website real quick? And
oh yeah, sure, I appreciate it.
This is where you could find Adem's website. You can find him on Twitter at Radical Adem, ADEM, and there you go. There's his website. And if you want to, if you need to exercise your brain, I know a lot of older people do these different types of brain exercises. All you have to do is read Adem, and that'll make your brain work. So I really appreciate you being here again, buddy.
Yeah, thanks, Dale. It's always a pleasure to have me on, and I hope to talk with you again.
We'll do it. I'll get a hold of you on Twitter, and so Adem the bear looking to fade this rally in S&Ps, and deflationary and the housing bear as well. Thanks for sharing your ideas with us today, buddy.
Great. Thanks for having me on, everyone. Have a good day.
All right, my trading warrior brother, Adem. Radical Adem Turkman, is that correct? Your last name?
Tumerkan.
Tumerkan. Well, not bad for live TV.
Anyway, it's a Turkish name. Everyone pronounces it wrong. I appreciate it.
And go meet Blake. It'll be, get a hold of.
Yeah, we're gonna have to get coffee soon.
Yeah, and that's a wrap, everyone. So don't just count your bearish narratives, count your blessings, and we'll see everyone tomorrow. I have Angie, goddess of grains, with us tomorrow. If you haven't noticed, the grains have been getting hammered, and I'm thinking that we could be close to some type of entry. So see you tomorrow. You could join the team in 13 minutes on the Morning Edge. You're welcome, Jeff, Sinatra. Thank you for being with us today, Adem, and thank you everyone for your attention and support. The way to say thank you for what we're doing for free on F.A.C.E here is to join our community. Adios, everyone.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.